Mass exodus as investors flee China, and the U.S. is next. I'm your host, Steven Van Metre, and thanks for joining me today. And turmoil in the foreign currency and equity markets centered on China right now has many people questioning what's going on over there. But hang tight, because the U.S. isn't far behind. Let's head over and pick this story up from Bloomberg, who headlines that the plunge in China's markets intensifies as yuan hits one-year low. And you can see here from this chart that pulling up stakes as Chinese stocks saw a rare monthly outflow by foreign investors in March as they look to get out. But why are they wanting out? Well, sentiment toward Chinese assets has soured as COVID lockdowns, slow economic growth, and policy stimulus fall short of investors' expectations. Domestic equities have lost about $2.7 trillion of market value this year, prompting the authorities to step up efforts to halt their decline. And this is just a simple concept of investors look to get a return on their money. And right now they're looking at China, who is still largely locked down, and saying there's not going to be any return there anytime soon. And so they're headed to the door. The Hang Seng China Enterprises Index hits 5.6% this week, the biggest drop in more than a month. Other assets are also under pressure, with the onshore yuan on track for its biggest weekly loss since August 2019. Now, the question you might ask is, well, why is their currency losing value? Well, perhaps it's because another currency is gaining value. And when you peg yourself to the dollar and the dollar starts to rise, well, you've got one direction you're probably headed. And here you can see the nominal broad U.S. dollar index has been steadily rising. And with the Fed looking to hike rates, it's expected that the dollar is going even higher. And the authorities are taking action to stem the declines. At Thursday meeting with investors, the securities regulator called on the country's giant Social Security fund, banks, and insurers to boost their equity investments. And this is a recurring theme that everything about the global economy hangs on global equity markets. The next time they go, and they will, you think about what policy tools the policymakers have left. Can they go to fiscal stimulus? Well, that caused a lot of inflation. Central banks? No, they're battling inflation, can't ease either. They're running out of tools. And if the equity market goes, I want you to be thinking they've got no way to stop it this time. And this was followed by a series of articles in state media. And just so you're wondering, that is translated to propaganda put out by the Chinese government, projecting confidence in the economy and markets. The concerted efforts underscore growing pressure on authorities to boost confidence before a closely watched leadership confab that's expected to confirm a president-breaking third term for Chinese President Xi Jinping. And this isn't the first time the government has urged institutional investors to increase positions. A similar call was issued less than 2 weeks ago, following a request made in October 2019. Again, when in doubt, get everybody to buy stocks and keep the market up, because if they can't, well, a lot of things go down with it. With no end to tight COVID restrictions in sight, overseas investors offloaded 45 billion yuan of stocks in March, the largest outflow in nearly 2 years. And while global funds slashed their holdings of Chinese bonds by the most on record that month, the authorities have shown little alarm about the withdrawals. Obviously, Beijing wants to stem the bearish sentiment about both the economy and the stock market. But keep in mind, the economy is like a giant ship. It takes time for it to turn around. So even if Beijing wants to talk up the market, it's hard to change how investors are thinking. And that's the fear, is because when stocks start to go down, people lose their wealth effect, they start spending less, and then it just is a self-feeding spiral as less money flowing in through the economy leads to lower stock prices, lower spending. And now what do central bankers do? Well, when you're chasing inflation, there's not much you can, because the data in China, it doesn't look good. Check this out. As China's services sector activity hit hard by Omicron surge, the Caixin PMI, check this out, the Caixin Services Purchasing Manager Index dived to 42. Now 50 means unchanged from the prior month, and over 50 means an expansion. So it's a degree of how much over 50 is how big the expansion is. If it's under 50, it means it's contraction. And that's bad news for the world's largest exporter. It dived to 42, signaling contraction in March from 50.2 in February. Meaning February was virtually unchanged, dropping below the 50-point mark that separates growth from contraction on a monthly basis. The reading indicates the sharpest activity decline since the initial onset of COVID-19 pandemic in February 2020. And it just goes to show how bad things are in China and potentially getting worse. And that has a feedback effect that could hit the U.S. equity markets. Right now, everyone's is running there for safety, but that won't hold. And if you're concerned that China could lead the world down into recession and what that means for your portfolio, well, I'll put a link up here for Portfolio Shield. Be sure to check it out. There's one in the description below. You'll be glad you did. Let's continue on because the rest of Asia, well, not looking too hot either. As we see this headline from the Associated Press that the Asian markets sink after the Fed chief's comments on inflation. But what does that why does the Fed have any impact on Asian markets? Well, they do. And Asia shares fell on Friday, tracking losses on Wall Street after Federal Reserve Chair Jerome Powell indicated increases in interest rates must be faster to fight inflation. And the Fed has already announced a 0.25 percentage point hike, and Wall Street expects a 0.5 percentage rate hike at its next meeting in 2 weeks. Other central bankers have moved to raise interest rates to try to temper the impact of rising prices on businesses and consumers. So I want you to understand from the first paragraph, all the Fed is trying to do here is reduce demand. And how do they do it? By tightening monetary policy. So there again, they believe there's too much demand, not enough supply. They can't deal with the supply issue because, well, it's a supply chain issue. But they can deal with demand, and so they're trying to pull back on the demand button. Let's keep going. During the panel discussion on Thursday, Powell suggested there's something in the idea of front-loading aggressive rate hikes as the Fed grapples with inflation that has reached 4-decade high. That suggests a 0.5 point increase could be on the table when officials hold their next interest rate and policy meeting May 3 through 4. Powell said, and in the past, the Fed has typically raised its benchmark short-term rate by more modest 0.25% increases. And all you can take away from that is the Fed is looking to slam on the brakes here. Now, what does this mean for the rest of the world as we go into our last article here is when the Fed raises rates, what are they trying to do? Well, they're trying to increase the value of the dollar. And that's one of the ways you tighten monetary policy is you raise rates, it increases the value of your currency. Now, from the rest of the world's perspective, and think about China, as we saw in the first article, that their yuan is slipping in value. Why is that? Well, when you peg yourself to the dollar that's rising, you either have to tighten monetary policy along with the Fed, or you're going to actually face higher inflation. So now what the Fed's doing, and I want you to understand this, they're putting pressure on every other central bank around the world that you either hike or you're going to face inflation. And that is a big problem for a lot of other countries because it's not like there's somewhere in the world that's sitting on low inflationary numbers. Everybody's facing inflation. Everybody wants it to stop. The Fed slamming on the brakes saying, we're going to do this and you better come along with us. All right, check this out from the Wall Street Journal's bond yield stabilized, futures edge down after hawkish Powell comments. A sell-off in U.S. government bonds calmed Friday with the yield on the 10-year Treasury hovering near multi-year highs. And Mr. Powell's comments injected fresh volatility in a fragile stock market that has been whipsawed this year by the war in Ukraine, soaring inflation, and rising COVID-19 cases in China. As many traders are now worried that the Fed's tightening cycle could tip the economy into recession at a time when consumers are already feeling uneasy about the economy. Next week, investors will parse fresh figures from the University of Michigan on consumer sentiment. Of course, one of my favorite indicators. So what is the issue here as we look at corporate profits, which we'll see in a moment, they're pretty high. And what does it mean when the Fed pulls back on those reins and slows demand down? What does that mean for corporate profits? Yeah, they're headed down. And that's why what I've suggested at the beginning of today's show is money is leaving other parts of the world and coming to the U.S., which is why the U.S. equity markets have been rather resilient. But what follows out of the rest of the world to come here means if they're not exporting, we're not importing, we're not selling, less revenue, less profits, and we're the last on the table of what is to come. For now, investors have been encouraged by strong first quarter earnings. Of the companies that have reported so far, nearly 80% have beat analyst expectation and has provided some stability to the U.S. stock market. And even with Thursday's losses, the Dow, as well, it was on pace to end the week with a 1% gain, and maybe not after today, but it gives you the idea of why the U.S. is coming next, because where this starts is in other parts of the world with exporters, and eventually it comes to importers. And we know that U.S. consumers are struggling under inflation, and it's going to get worse. And that means that perhaps the stock market has already figured out what's coming, and that's why you're seeing equity prices head lower. I'm Steven Van Metre. Thanks for being fans. Thanks for watching. Bye now.